It's been another busy earnings week. We love it. We love the tidal wave of news. Our guest says, though, you shouldn't invest based on quarterly earnings. For his strategy, let's bring in Jason Del Vicario, Portfolio Manager at Hillside Wealth Management. That's interesting, Jason, and thanks for joining us. You think you shouldn't invest on a knee-jerk reaction to results?
Not necessarily a knee-jerk reaction, but quarterly results for a company just give you an insight as to how the company has done over the last 3 months. We believe that investors should be focused on much longer periods of time, and 3 months is just not enough to get a good sense for how a business is going to perform 5, 10, 15, 20 years down the road. I'll point to a recent study that was done where the average holding period of securities now has fallen to 10 months from five years in the 1970s. Can you imagine owning a business where you're selling and buying that business every 10 months? It makes absolutely no sense. And we would really rather investors focus on much longer time frames than 3 months or 10 months.
You must be interested, though, if you see a stock you like long term and it gets hammered on earnings, does that not incline you to pick up some more shares?
That gets us very excited, Andy. It depends. There's a caveat here with the caveat being that if the long-term thesis of the company remains intact, I'll give you an example. So Meta last year, Meta dropped 75% from its peak. And we, while I say investors shouldn't be focused on quarterly earnings singularly, we obviously look at quarterly earnings. And what we're looking for is indications as to whether the long-term thesis of the company has changed, our investment long-term thesis. And so, for example, Meta last year struggled, and businesses struggle. This is normal in the lifespan of a business. No business goes up 20 or 30% operationally every single year, or every single quarter. And so, for example, with Meta, we kept looking at this and we're saying, okay, so they have 3.8 billion daily active users, monthly active users. That is our long-term thesis with Meta, in that they have a massive network effect. And so, yes, as the company was falling, we were able to add to shares. But there are some indications sometimes where the long-term thesis is frustrated or broken for a company. So that would be the caveat in terms of if you do see a spike down in price of a company you like long-term.
Talk to us about the airlines. Air Canada's business zooming back. Can you talk about airlines in general? Are you keen on the sector?
Sure. Awful business, terrible business, and for the simple reason that they are not asset light. They require massive amounts of capital to maintain and grow their operations. Our preference are for companies that can grow and or maintain their operations without needing tremendous amounts of capital, because that tremendous amount of capital can otherwise be directed to us as shareholders or back into the business to grow the business. So airlines have been a terrible business for a long, long time. The other thing I'll say with Air Canada is that it is not founder-run, founder-owned. They have a professional management team, and we have seen study after study indicating that when you have the insiders, management, or owners of the company have large stakes in the business, they tend to make decisions that are aligned with shareholders because, of course, they are large shareholders and very much long-term focused. So, the airline business has been a great spot for destruction of capital over the decades.
Sorry, what's your broad? You don't tend to see much insider ownership in airlines, you mean?
No.
Okay. You have a Japanese idea for us. Kaku trades in Tokyo, obviously. They're involved in restaurant reservations, but also price comparisons. Can you tell us a bit about that? An unusual idea, or one I've never heard of?
Right. So in contrast to airlines, Kaku has basically 2 websites. And they are the second largest restaurant reservation site and restaurant review site. Think of Yelp, the Yelp equivalent in Japan. They have something like 60,000 restaurants, and then they have something like 45 million people that go onto their website every month. That, other than setting up the website, that does not take a lot of capital to maintain or grow. And as they add more restaurants and as more users come to that website, that network effect just gets bigger and bigger. Same thing with their price comparison site. Websites or platform businesses are very interesting because, as I said, they don't require a lot of capital to grow. Think again of Meta. Meta really at the core of it is a website or an app. So these types of businesses are very attractive to us. And of course, Kaku, through their ownership of Digital Garage, which is founder-run, founder-owned, is a founder-run, founder-owned company. And so, of course, that gives us some comfort that management and the large owners are aligned with our interests, us being the shareholders.
Constellation Software has long been a holding?
Mm-hmm. Yes, yeah, we've owned it since inception in 2014. This is another really good example of a recent quarterly result where we got some insight and sort of some enhancement of our long-term thesis. So Constellation Software acquires other software companies. And in the first quarter, so in their fourth quarter results, they noted that subsequent to quarter end, they had deployed approximately $800 million of capital in acquisitions. So our investment thesis, long-term investment thesis, is that for Constellation Software to continue to generate strong shareholder returns, by definition of the law of large numbers, they're going to need to scale up their acquisition machine, and we're getting indications that they're able to do that. Secondly, we've also had the thesis, and which hasn't yet really been tested, but for recently, that companies that are disciplined and don't rely on massive amounts of debt to fund their acquisition machine, they should, in theory, do better than, say, private equity, which does rely on debt, or other undisciplined acquirers during periods of economic weakness. And so we're seeing a sort of a two-banger, if you will, here. Mm-hmm. Number one, their acquisition machine is scaling nicely. And number two, they're taking advantage of challenging conditions for their competitors to do more acquisitions at favorable prices. So our investment thesis, our long-term investment thesis, is enhanced with this information.
We're tight for time. Alimentation, another consolidator that you think is a good long-term bet?
Absolutely. Yeah, just same thing as Constellation. We've seen indications that not only are they disciplined at acquiring, but they're able to be a bit more aggressive, be a bit more on their front foot during this period of tightened liquidity and higher interest rates. Yeah, fantastic company.